Hello and welcome. My name is Grant Collins, and in today's discussion with the AIM Research video podcast, I have a special guest, Dr. Dan Thornton. For those of you that aren't familiar with Dan, he retired from the Federal Reserve Bank of St. Louis in 2014, and he's currently the president of D.L. Thornton Economics. Dr. Thornton received his PhD in economics from the University of Missouri and a master's in economics from the Arizona State University. He's published over 100 papers in leading economics and finance journals and in the Federal Reserve Bank of St. Louis Review. And he's also published a large number of essays in the St. Louis Fed's economic synopses and on his website, dlthornton.com. He's ranked in the top 2% of monetary economists and the top 3% of all economists by RecPec, if I'm saying that right. He's a research fellow at the Show Me Institute, the Center for Finance and Credit Markets, the Hammond Institute for Free Enterprise, and the National Center for Food and Agricultural Policy. I can finally take a breath, Dan. It's great to have you. Again, I'm always appreciative and grateful for your time. Welcome to the AIM Research Podcast. How are you, Dan?
Fine, I'm doing fine, and thank you for inviting me. This will be very interesting, I think.
Very much so. To set the lay of the land for our viewers and listeners, we're going to talk a lot about this most recent bout of inflation, and then really hit on your expertise being an insider of the Fed, and really hit on the effectiveness of the federal funds rate and then the asset purchase programs that have come through. So I might want to start with the inflation conversation. So primarily to, again, set the lay of the land, we've now kind of come through a situation where the CPI report, the last reading that came out, was close to 7%. We know that the Fed has done this new averaging 2% for some time target. So that is well above their target, but there's a lot of discussion around transitory or persistent or permanent. I'm wondering, Dan, how are you viewing inflation? How are you thinking about it? And what's your overall view that the Fed's taking and that you're thinking?
Okay, well, people don't understand. In order to be kind of persistent, inflation has to have some kind of driving force that's persistent. So right now, I mean, a lot of the inflation is undoubtedly associated with the supply chain problem that we're exhibiting, but I suspect there's more to it than that. If that's all it is, what we'll have is, the prices will go up, there'll be inflation. Some prices will stay up forever, but the inflation will then settle kind of down to probably what it had been before. But I suspect there's other things going on that will affect that inflation. And so basically, I always look at what happened in the Great Inflation to give us kind of an idea of what driving forces might be working, right, to keep this inflation going, even once the supply chain problem is completely resolved. So basically, I think you've got a slide of basically the Great Inflation here, which is, prices went up and started going up in the mid 60s, around 64, so sometime. Then they peaked, then the inflation rate started to fall, then it jumped up again. That first jump up is associated basically with OPEC, right? So OPEC seemed to have an impact on that second rise, but then it came down again. But of course, it stayed above its previous level. And then it really went up. And we got up into the 16% inflation rate. And then it dropped very dramatically and that's often attributed to the Fed adopting a new operating procedure. They went from basically looking at a wide range of things, mostly monetary aggregates, to looking at something called non-borrowed reserves, which is total reserves less the amount of reserves borrowed by reserve banks. And basically, so if you turn to the next slide I think, you look at that and you can see that first spike looks like it's so associated with a big jump in oil prices, right? And so that's the black line. The second spike is also associated with that. And the decline is kind of associated with it. So it kind of says, you know, maybe oil prices really had a lot to do with the inflation that we experienced in that period of the 70s, but it tells us nothing about what happened in the 60s. All right, so if you take a look at the next slide, that shows money growth. And so we see money growth has accelerated basically way before the middle 60s. And it could be that that first big run up was associated with money growth, not inflation. But then you look at the rest of it, and it doesn't look like money growth had a particularly important thing to do with it. And in particular, inflation was going down during and after the recession in 1982. And prices were coming down, inflation rate was coming down. So it looks like money had nothing to do with bringing the inflation rate down. Oil prices look like they have a contributing factor, but if you go to the next slide, right, here you have wage growth, right? And so wages were increasing. They went down, then they increased, then it went down, and they followed that. And some might say, well, they were caused by inflation. Inflation's going up, but wages were already increasing well before that kick in 64 and then in 1964. And they precede all these spikes in inflation, which kind of makes you think that, well, there could have been something causal in there as well. And they actually fit the data almost better than money or oil prices. So what we've experienced here recently is a lot of people deciding that they either want to work for a better job or they need more money for doing the job they're doing. And it could be that wages could be, and labor market conditions could be a factor that will keep inflation going long after the supply chain problems are resolved. I don't know for sure, but that at least is a possibility. What I do know is if it's just supply chain, it will, probably last another year or so. The supply chain will get fixed and inflation will come right back down. And this will be just a transient kind of event. I really don't think that's going to happen for a couple of reasons. One is the wage problem. The other is there's so much liquidity out there created by these QE programs that the Fed, Bernanke Fed started and Powell then kind of went on he did he took it to a whole new level. So there's just a tremendous amount of liquidity out there. So if this inflation gets going and inflation expectations start to ramp up, people start expecting more inflation. And so they start consuming and they accelerate their consumption, right, in anticipation of further price increase. There's certainly a lot of liquidity out there to drive that process.
And to your point too, that seems to be the missing piece this time around, right? So we've got the supply side shocks, and we had the paper over in demand from the fiscal response, providing the stimulus checks to families.
Big time.
But now, as we're seeing some of that wear off, we're starting to see personal incomes come back down again, and so it'll be interesting now that we've passed kind of this full employment mandate that the Fed is looking at, or at least that was the comment from the last FOMC meeting. It'll be interesting to see how wage pressures tick up from here going forward.
Yeah, and as you pointed out, the CARES Act was just is necessary to help people who needed money, right? So the humanitarian aid part of that was fine. But they actually gave money, large amount of money to people who had twice the disposable income, twice the median income. So, you're you're giving money, a large amount of money that had household incomes of $150,000. And you're giving a large amount of money to individuals who had incomes of about $75,000. That makes no sense.
Mm-mm.
No, it was just, and in fact, that's, in my opinion, one of the things that kind of got this acceleration of inflation associated with the supply chain problem. Just all this liquidity is sitting out there. So
And it went to people who had higher marginal propensities to consume.
Yeah.
Yeah, that makes really sense. And I think your slide here, not to kick too far ahead, I think maybe this brings up a really good point that it truly is a process. Talk to me a little bit about that.
Yeah, you've got to have something to keep it going. All right, so historically, people have thought about money. So the standards, still a fairly standard story, which doesn't seem to be true, is that too much money chasing too few goods. So you start printing money supply and demand for goods goes up, and then so you can keep that going, right, by just doing what? Printing more and more money, right? That's what happened to Germany and after World War I. They were just printing money, and that was it. That does work, in my opinion, in a cash economy. But most of our money is not cash.
Mm-hmm.
A tiny, tiny part, relatively speaking, is cash. So if you have a cash economy, you'll see a lot stronger relationship between money growth, cash growth, and inflation. But once you separate that connection, like we have, that really breaks down considerably. So if you look at a Latin American country, you'll find, basically a cash country, and there'll be a strong relationship between money growth or cash growth and the economy, money growth and the economy. But in an economy like ours, it'll go away. If you look at China, for example, historically there was a fairly strong relationship, but as they convert more and more to the kind of system we have, that relationship seems to be going away. So I've always attributed that to the fact that works in a cash economy for some reason. And I think it's just because we have so many different ways of financing transactions, it doesn't work in a modern economy like the one we have.
And if I'm hearing you right, it's because of more of the financial assets are available or the credits available in the economy.
I make probably 95% of my purchases with my credit card. All right.
Yeah.
The money that backs that up is sitting in a deposit in the bank, and every month I just pay it off. But I make one payment. I don't. So if I want to ramp up my spending, I can just put more in credit card. I can go out and borrow. I can, if I want to buy a Bitcoin, which you should never do, you can finance it with Bitcoins. I mean,
that's a different rabbit hole. I don't know if you want to open that rabbit hole.
Well, I've written about it. So it's just another means of making transactions. And I think it'll eventually burn itself out.
It reminds me quite a bit about the book of the history of the United States in 5 crashes, and how each one of those crashes was brought on by new financial innovation. And it just makes you wonder if cryptocurrency is that. It's a side tangent, it's a side thought that's on my mind.
Yeah.
So kind of circling back. So with inflation being a processing and having something to keep it going, the Fed now has to kind of turn and pivot. They started by saying, this is transitory. We're going to continue to provide the easy money and the easy policy that's currently in place to support the economy post-pandemic. And we now have them pivoting back and saying, okay, now it's a problem. Now we're concerned that it's going to stick. And now they're moving on to the side of raising interest rates and then cooling their asset purchases. My big question there is maybe thinking about the effectiveness now that they're starting to taper now, right as the economy seems to be starting to slow down again as we're getting new variants lock down the economy. Can you talk a little bit about the effectiveness of Fed policy, maybe in the past, and then maybe we can hit on the present?
Well, in the past, it's never been effective. Basically, and that they don't have this. This will do nothing to quell inflation. All right. It's a big can of worms we just opened. Basically, what you have is a situation where they can't really do anything about inflation. If inflation started, for example, it due to wage problems. People are wanting more money, and then it starts to accelerate because of people expecting prices to go up. So that's a process that just kind of feeds on itself. They'd have to basically almost shrink their offset purchases back to where they were in someplace in the 2010 2011 level. There was so much liquidity out there, so they'd have to drain just an incredible amount of that liquidity out of the market. Tapering, I mean, that just says you're not going to buy any more. Mm-hmm. Well, you're going to buy less, and then in March they're going to stop buying, but that does nothing to take away everything they created. All right, so basically that's not going to have any impact. They really don't control this idea that the Fed controls interest rates is long overdue to be brought to an end. I think you put up the slide here with the financial crisis, right? So this is a case in point. So the financial crisis was dated basically as beginning on August 9th of 2007, when this French bank reneged on some of their assets. And then all of a sudden everybody woke up and went, ooh, wait a minute, we have a problem there. But it was really going on a long time before that. So it was in the works well before August 9th of 2007, but that's usually given as a kind of the starting date. And you see what happened there, that arrow points to a little spike in the federal funds rate, and then it dropped, right? And the federal funds rate, and that's the target, federal funds rate below the target. This other was a 1-month Treasury rate, and you can see that thing just continued to decline, right? And the Fed started adjusting the federal funds rate target down, and the funds rate followed it down. But once we get to Lehman Brothers bankruptcy, which is in September September 15th of 2008, which is close to the end of that. Probably close to I don't know if I can put my cursor on that.
I can probably
right about here, somewhere in here. And you see those two large spikes in the federal funds rate, and then it just collapsed. So the Fed made those last two cuts, the last three cuts. It doesn't show the one where they took it from 1% to between 0 and 25 basis points. All those they just had to make. And if you read the transcripts, they kind of did this as if they were changing policy. But all they were doing is being forced to cut the target down. So that really had absolutely no effect, because those weren't even real actions taken. So if you pull up the next slide, what did they do? Well, this is they started making loans. So that kink in there, that little inflection point, is September, all right, of 2008. That's Lehman. And initially they made loans. So they were making loans to banks, which was the right thing to do, by the way. All right. And then they decided that they needed to do something else. And so they began QE. QE1 here was something that dated on, it's actually the date was November 25th of 2008. And it was the Board of Governors, not the Federal Open Market Committee. So the Board of Governors has a lot of separate things. Federal Market Condition Committee is supposed to do monetary policy. But the Board of Governors made a decision that the Fed was going to buy $600 billion worth of assets, mostly MBS, mortgage-backed securities. All right, so that's the date of that. And then it went up, and then in March, roughly where the arrow is pointing, it was actually March 18th of 2009, the FOMC adopted the policy that the Board of Governors had already instituted, right, in effect. And they decided to buy another 1.15 trillion of long-term treasuries, agency debt, Freddie, Fannie debt, and MBS, all right? And so that caused the next increase. And then QE3, they decided to buy actually some more. And then finally, in October of 2014, they ended QE. All right. And then, of course, with our 2-month recession associated with COVID, it actually began on February and ended in April. The Powell Fed decided to do QE on steroids. So they immediately reduced the federal funds rate to between 0 and 25 basis points, and then decided they're just gonna buy an incredible amount.
I had a question to that. That's something that has, at least in my short career being much younger, it feels like from the Fed, it's always a double barrel approach. So they're, raising rates, providing, quantitative tightening or tapering, or they're doing, dropping rates and doing quantitative easing. And they're doing, again, both of them at the same time simultaneously, or it feels that way.
Well, the problem is that, they've been doing this QE so long now that people think of that as what was normal. No, it's completely abnormal. All right. Historically, the Federal Reserve had a policy of buying very, very short-term treasuries and conducting daily open market operation. And I mean short-term. So these things were a couple weeks, month. And they did that for 2 reasons. One is they didn't want to have a big impact on interest rates in particular. They wanted the market to determine interest rates. Right? And the second reason is they didn't want to do anything to allocate credit. So they never bought anything but treasuries, never bought anything but short-term treasuries. Now, because the monetary base has to increase typically over time, they needed to once they started getting too many short-term securities, they would transfer those into longer-term treasuries. So they did buy long-term treasuries, but only treasuries, and only because they know that these reserves they just added were permanent now. They're going to be permanent. And so they brought long-term securities, which are a little more permanent. They always conducted in very short term. Before Lehman, remember the financial crisis started back here in 2007. Before that, we were lending to banks through something called the TAF and a couple other things, but we were sterilizing every bit of that. So reserves, this is monetary base, which is total reserves plus the currency component of the money supply, didn't increase at all. So reserves didn't increase at all because we sterilized it. So sterilization means we make loans and then we sell off treasuries. exactly the same amount that we bought. So we have no impact on bank reserves at all, or the money supply. So they were doing that because they were concerned that increasing the money supply would cause inflation, or could cause inflation, right? But they didn't realize, in fact, I don't think they've ever realized that buying assets, treasuries, or anything else, causes the money supply to increase dollar for dollar. So the reason this happens is if the Fed buys a treasury from somebody in the market, they usually buy them from government security dealers, right? What they do is effectively write a check against the Fed, right? All right. So what happens is the seller of the security gets the check. He runs down to his bank and does what? Deposits it in the check, right? Now what's happened? The money supplies increase.
Right.
Those deposits are new money, right? Right. The bank takes the check and deposits, comes to the Federal Reserve and say, okay, pay us. And so the Federal Reserve deposits a bank's account, which are reserves. So reserves go up, but the money supply is already increased. So if they buy $5 trillion worth of securities, the money supply goes up by 5 trillion, period. So they were trying to keep the money supply from going up and doing something that caused an enormous increase in the money supply.
Really, truly running an experiment. Sorry.
Correct, because they didn't know what they were doing. There was no theory to support this QE idea. In fact, I think I have a slide later that has a quote on it that basically says they didn't know what they were doing. So basically, the other problem is they did this. Not only didn't they realize that this was going to cause the money supply, I don't think. I've never seen anything in all the things I've read that gave me any indication that they ever believed that. They knew it. The other thing is that what I like to look at if you're looking at a financial crisis, what you're going to see is increases in risk spreads, credit risk spreads. That is the spread between a safe asset and an asset that's more risky. All right. And the reason is when there's a financial crisis, it's a flight to safety. Everybody wants to get out of risky assets and get into safer assets. So you see here, this is the commercial paper and the federal funds rate spread. And you see that back in 07, it spiked up. Then at the outset of the financial crisis, which at the outset of Lehman Brothers bankruptcy, financial crisis, the recession began in December of 2007. And so this downward spike was associated with the recession, and the upward spike, big spike when it started up, was associated with Lehman Brothers. It peaked. And then it was already starting to get down. The recession ended in June of 2009, and the thing was already starting to drift down when we did QE. So this is telling me, and the next slide does the same thing. You can pull it up. This is telling me that the financial crisis would be already abating. So this spread, it has two spreads. One is a 3-month financial commercial paper and the 3-month Treasury bill, right? So this is the risky guy. Financial paper is the risky guy, and the T-bill, right? It's obviously the safe guy. And this is the 6-month negotiable certificate deposit rate, which is also a risky rate, against the 6-month Treasury. And you see both of those spiked on as of August of 2007, and they stayed up. And then this is Lehman Brothers. That's the second line, and you can see what happened when Lehman Brothers. Whoa! But you also see that by here, this is the end of the recession, end of the recession. this is June of 2009, you can see these were already abating. In fact, the 3-month spread between financial commercial paper was way down here. This is about where my cursor is, if you can see it, is about March of 2009 when we decided to buy another 1.15 trillion of long dated security.
And the
So
crisis
they
was
were
over.
unaware that the recession and financial crisis were about to end, completely unaware. In fact, Janet Yellen made a statement at the March meetings to the effect, you can find it in one thing I did for Cato and a few other places because I like to comment so much. She said, I think we're in the midst of a very severe crisis that's not likely to end anytime soon. 3 months later, boom. Well, they didn't know that though.
Right.
So the dating committee didn't determine it was over. This was the ending date until it was September of 2010, I think. But if you go back to the preceding slides, the one that shows when they did QE, right? That second QE, they knew it was over. They knew the recession had ended, right? QE3, they knew it, right? And in here, they not only started again, but during this intermediate period, they actually accelerated it. They started buying more. I think it was initially it was 40. They were buying 40 billion a month, and they went to 85. I think that's right. I don't remember. Don't remember for sure. So, I mean, first of all, they didn't realize that the policy was going to create as much money as they were trying to prevent. Right? They didn't have a theory for it. No theory about how it worked. Right? They did it because they thought they had to do something, and I think they didn't know what else to do. So that's what they did.
And yet it was one of the slowest recoveries post a recession ever.
Yeah, well, I think I've got another slide in there that will demonstrate that it did nothing at all to output growth. It just did. So this is the, if you say, well, how effective was it, right? So the slide you just pull up. These are the QE dates. When I put this 18th of 2000, that's actually, I have those labeled wrong, by the way. I just noticed that. So the first one is the QE1 is when on November, these are daily data. So this is November 25th of 2008, when the Board of Governors announced they'd buy 600 billion of treasuries and other stuff. Oh, actually, mostly almost all MBS. And on that day, the 10-year treasury rate dropped about 25, 26 basis points. I don't remember exactly. And they attributed that to the announcement that they were going to do this. But as you can see, and it's hard to see here, actually, the 10-year treasury rate had already declined about 30 basis points or so. And before that. So that could be just, the flight to safety, and because of the recession was getting worse. And then it continued, but down here, and this is December. This is like the last day of December of 2008. It started to go up again. Then this was actually QE2. I'm sorry, I apologize. This is actually QE2. This is March 18th of 2009. This is when we decided we would buy 1.15 trillion of MBS treasuries. And on that day, and you can see it pretty clearly, that the 10-year treasury dropped 50 basis points, right? But then you can also see that didn't last long. So it's kind of an interesting story. At the March meeting, Um, and I think that the following meeting was in April. In April, Janet Yellen said, wow, she said that I really thought, buying treasuries was a good idea and had a big effect on interest rates. And I think we should buy some more. All right. By June, right, which is right in here someplace, the 10-year was now about 121 basis points of what it had been on March 17th of 09 before they took the action. And now she's saying, well, I really thought that was going to work, but there's I can't find any evidence that it really did, but I still think we should maybe continue to do it.
We haven't gone big enough yet.
Yeah, that's right. We need to do more. So you can see this is the one in 2010 or whatever. I'm losing my dates now. But rates were falling ahead of it. They decided to buy some more, and what happened? Rates went up. This is the last one. There's no evidence whatsoever, right, that QE affected long-term rates. So I've done a whole bunch of research in this area. Most people associate it with the impact of the announcement. So there's something called an announcement effect literature. Mm-hmm. And what you do is you take an announcement, right, and you see what happened, that the interest rates or stock prices or whatever, the asset, on the day following the announcement. So you pick your windows short enough that you get the announcement idea in there. And that literature is just so flawed that it's not even funny. First of all, in order to associate it with announcement, it has to be that announcement, right? And truth is that there's all news coming into the market every day.
Right.
So if we say something, right, and then it goes down, right? Well, is it that announcement, that piece of information that drove it, or are there other pieces of information that could have driven it? All right. So that's one problem with it. There's just, it's blurred in with all kinds of other things. The other thing is if it's short-lived, right? If it goes down and turns around and goes back up, well, it can't have any effect on spending, right? If you're going to drive interest rates down and interest rates are going to cause people to spend, lower interest rates are going to cause people to spend more, it's got to be permanent. Mm-hmm. I mean, it doesn't have to be permanent, but it has to be persistent, right? If it reverses itself quickly within a month or two, then it just couldn't possibly have had any effect whatsoever on spending. So there's other things like statistical significance that people don't look at typically. So anyhow, I did a whole paper. I looked at all the announcements that have been used in that literature, and I really did a careful job of separating the wheat from the chaff. And the only announcement that, as I recall, this one here is really bad, because this announcement occurred before this announcement occurred. What's that? Before the market opened. Anyhow, this announcement is really not associated with anything. So the only one that was left was this one here. So that one looks like it was due to the Fed's announcement of they were going to buy a lot of securities. But again, it was what?
Short-lived.
It went away.
Yeah, it's short-lived, yeah.
So I took all the announcements that have been used in the literature. I did it very carefully. I looked at the frequency. I used tick-by-tick data to differentiate the frequency of the announcement. If the announcement was really that thing, then it had to have an impact immediately. And the daily impact should have been pretty equal to the immediate impact. In most of the cases, it wasn't, right? Which means other news that came in after the announcement, right, offset it, right? In some cases, it was so bad that it wasn't that it was smaller. it was the data change was a different sign. So if the announcement effect was negative, right, within a short window of, let's say, I think I used 15 and 45 minutes as the window. So if that was negative and pretty big, right, then the daily change was the opposite. It was positive. So it got completely offset within the day. It was this high one thing and it was gone. So basically that whole literature is just, and it's, they're not only, I did this, but now there are lots of other people who are kind of looking at that and saying, yeah, there is nothing there like.
And it's almost as if the market had already done what they wanted it to do.
It just didn't have any, it was something, it's not surprising that if you make a big announcement, initially the market's going to do something, and it may even be on the day, but once the news comes, new information comes in that this is really not going to be anything, everything goes away.
That's a really, I guess, interesting point, because then it brings up the question in my mind, well, seeing, this chart and hearing you talk about, the ineffectiveness of QE, and then even seeing, the rates that we talked about earlier, that the rate market even moved, potentially before the Fed can move. What tools do they have left? Forward guidance is the only other one that they tout as a potential tool.
Yeah, no, forward guidance is just completely wrong. Well, first of all, it's based on the expectation hypothesis of the term structure of interest rates, which argues that long-term rates are determined by the market's expectation of future short-term rate, right, over the holding period of the asset. So that would tell me that 10-year Treasury rate is based on, let's take the short-term rate as being the federal funds rate. It's based on the market's expectation for the federal funds rate over the next 10 years. All right. What do we know about interest rates? They're unpredictable.
Right.
Right. So markets are going to have I'm going to base my decision to buy a 10-year Treasury rate, price a 10-year Treasury rate, on what I think the federal funds rate is going to be 10 years from now, when I can't even predict what it's probably going to be tomorrow, because the Fed is likely to do, if we got a really bad shock, they'd raise it today.
Right.
They wouldn't wait till March. Right? They wouldn't wait that long.
Yeah, they left the language open. I mean, when you read the statement, it sounds like that they're going to be kind of dependent on the data and they're going to watch this a little bit longer. But then when you get to the J. Powell's questions, he's like, nope, we're determined to move into tightening policy.
Yeah, but even if you said it in terms of, let's say, the 1 month T-bill rate, right? Or the 1 year T-bill rate, right? The 10-year rate, I'm going to price the 10-year Treasury off of what I think the 1 year Treasury is going to be 10 years from now, when I cannot predict the 10-year Treasury rate or the 1 year Treasury rate is going to be next month with any accuracy at all. And I know I can't do that. So it implies that if you're going to use this idea, that this expectation hypothesis, it requires people to actually behave irrationally. They're
Right.
going to have to, they're pricing an asset on the future behavior of an asset they can't predict. Same's true of stock market. It's true of all financial assets. And the reason is very simple, actually. So there's something called the efficient market hypothesis, which actually works. This is not a bad idea. I don't know why it's called a hypothesis, because it's actually got more support, in fact, empirical support, than the expectation hypothesis, which is always rejected, ever did. All right, so it says basically, the price of any asset today reflects all the information known about the asset. Market participants know about the asset as of today, as of when that price was determined, right? including their expectations about any future events. Right? So all that is embedded in there. Now, what happens the next day, right? Well, since that price reflects everything that's happened, everything that people know coming up to that day, right? The market reaction is going to be the news, the new information that comes in that day, right? So the only way you could really predict what tomorrow's price is going to be is if you can anticipate not only what the news is going to be, but how the market's going to respond to that news. Right. So that's why virtually every financial asset price of every financial asset follows what's called a random walk, which is your best guess about what it's going to be tomorrow is what it is today. It's unpredictable otherwise. All right. Now, there are little models that will beat a random walk. In other words, show they have more predictability than a random walk, and they can even beat it in a statistically significant way. But that doesn't happen often, a whole lot, and it only happens at very short horizons. So if you go out longer, like 2 or 3, 4 months, and certainly a year, that's impossible. There won't be a model that can predict better than just saying whatever it is today is the right. That's what I think it's going to be. So it can't predict it. So there's just no way the expectation or the forward guidance, which says, well, if the Fed keeps its rate lower for a longer period of time, then they'll be able to affect long-term rates because of the expectation hypothesis. So if it's built on a myth, the expectation hypothesis, it can't possibly be correct. And there's no evidence at all. In fact, I've done papers on that too, but that one's a lot harder to get him to do empirically. So you have to do it logically. You have to show logically it fails.
Right. So then it gets to the point where they're running out of tools to use. But as you and I are kind of laying out here, it looks like there's no reason for them to act. Am I getting that wrong?
Well, no, that's part of the reason they did forward guidance is that it was a brainchild of Michael Woodford. Michael Woodford is one of the leading macroeconomists today. And he came up with this idea, and then he put together a model to show that it could work. Of course, the model is designed in such a way that it will work.
Of course.
Yeah, so that helped. And actually what happened is they adopted this right away in December of 2008 when they lowered the funds rate to between 0 and 2%. They said, we're going to keep it low for an unspecified time, right? And then they realized that, well, unspecified time doesn't give you a lot of forward guidance. So they started at the 2011 September meeting, which I actually happened to be at because nobody really wanted to go because it was going to be the most boring meeting of the year. So I went with the president. Anyhow, it became very interesting because they wanted to put a date on it. And so there were 3 dissents at that meeting on dating it. But anyhow, that's the first time they dated. So we're going to keep it low until, I don't remember what the date was, till some date in the future. And then they changed that date. They keep extending that date out. Then there was a big debate among the members of the FOMC about the difference between something called time consistent forward guidance, which is what they were doing, setting a date, a time, and state contingent forward, which is you make your contingency, we're going to keep the rate low until this happens. All right. And so they decided, and I think it was I have to think about this. Anyhow, I've written it down someplace, but I'm not good at remembering dates. Anyhow, At one meeting, they decided they were going to adopt state contingent forward guidance, and they were going to keep the rate at between 0 and 25 basis points until the unemployment rate got to 6.5%. So I was still at the Fed. So I immediately wrote an essay, one of these synopses that you mentioned earlier, saying, is this a good idea? Because the Fed has absolutely no control over the unemployment rate. Right? And the unemployment rate had already dropped considerably because of a historically large and unknown reason, for no reason, in the labor force participation rate. So if the labor force participation rate goes down, the unemployment rate goes down, because it's the it's the percentage of labor force that's employed, right? And so that's a smaller thing, and so the unemployment rate naturally goes down with it. So I raised the question, is this a good thing to do? Because you're doing something that you can't control, and setting something contingent on something you can't control doesn't seem like a good idea, especially when that's being severely driven by something else already. And so what happened is, long before they were ready to do it, raise it, and I think it was they kept that contingency went on, and about 13 months later, they took it off because the unemployment rate got real close to 6.5%, and they weren't ready to raise the rate yet. They didn't want to go off at 0 to 25 basis points, and so they had a new one which says, well, we're going to consider all kinds of stuff and then decide when we're going to raise the rates. So in other words, they went from having time consistent forward guidance, the state contingent forward guidance, to having no forward guidance.
So essentially, any way to get around kind of this rules-based environment, so they allow discretion to continue to stay at the forefront.
Yeah, well, I've interpreted this. They didn't have a theory for QE, and Woodford was pushing this forward guidance thing, and so they think, well, we might as well do this too because it might work. Right. So basically, we're doing anything that might lower long-term rates. Interesting, however, the theoretical foundations of those are polar opposites. So the expectation hypothesis, which is forward guidance, right, requires the markets to be very efficient. Right. The QE policy that they finally built a theory, which all turned out to be wrong, required the markets to be segmented, right? So segmented markets means you've got a market here that people like to invest in, and prices can really go a lot different before you get them to move to another place. So no market is complete. The only market that's actually completely segmented is the federal funds market, and that's by construction, because the only people can participate in the federal funds market are banks, the Federal Home Loan Banks, and Freddie, Fannie, a couple other government agencies. That's it. You can't go out and buy federal funds. I can't go out and buy federal funds. Nobody in the public can buy federal funds. It's a perfectly segmented market because these are the only people that can participate in it. So it's segmented by construction, actually.
So to skip ahead then,
yeah.
I don't want to go. I think then this maybe gets to that overall point. Then
yeah. So one of the things that really I think is misunderstood, unfortunately, by some economists, and certainly by the public, not understood, is that monetary and fiscal policy can have no effect on the growth rate of the economy. Impossible. All right. So the growth rate of the economy, output is determined by basically land, labor, capital, and technology. Right. And so the growth rate of output is determined by the growth rates of those, what we call fundamental factors of production. Right. So the growth rate of labor, growth rate of capital, the growth rate of technology or technological innovations, right? Land doesn't grow, so we have to, that doesn't have, well, unless you explored a new area. In fact, in, in the 17, 16, 17, 1800s, lands was always expanding
We'll
for
have
the
to see
rulers who
if
took it
the
over.
space
Yeah.
trips actually give
That's
us
right.
more land or not.
Well, I guess Russia's trying to make it expand now, right?
Right. Well,
But typically it's fixed. So this is something I don't think has been appreciated. This is the dashed line is the trend growth in unemployment in the growth rate of output from 1948 Q1 to basically the end of 2019. If you extended it, it looks pretty much the same. This might be the end of 20. Oh, I said, yeah, the fourth quarter of 19 is the flat line, and that's the average growth rate between 2010 Q1 and 2019 Q4. So this is I took 10 as the first quarter of 10 as the starting place, even though the recession ended in June of 2009, in the third quarter of 9, because I didn't want that little transition period to affect the number. All right, so it would have been a little lower than 2.3%. All right, not a lot, but a little bit. So I took that growth rate, and you can see that that's just the growth rate. Basically, it was at trend growth. Right? So they did all this QE stuff, right? And what happened to output growth? Nothing. But I knew that. Monetary policy can't affect the size of your labor force, the size of capital. If it has any effect, it's going to be a very transitory effect. It's going to be one of those deviations from trend, not the trend itself. All right. And so the same thing of fiscal policy. There was all this talk about the tax cut, the Trump tax cut, and that was going to be this big stimulus that really impact growth. No. Did it? It did it. Did you see any effect of it here?
mm-hmm.
No,
Yeah.
It's not going to do it.
Yeah.
Right. It's just not going to affect it. So monetary fiscal policy, as we typically define them, won't have any impact at all on growth rate of output.
And now we have them working in tandem.
I'm not sure the point you're making here.
Well, so it seems
like monetary and fiscal policy are both working.
They are de facto in a marriage between the Treasury and the Fed, for lack of a better word.
There is indeed.
So I think then that may get us to kind of your last talking point, because we have seen this explosion of the deficit, and I believe you have a slide on that as well.
Yeah. So this is the national debt. Go to the one before, because that's the one This is kind of important. So the red line is the federal debt held by the public, which is mostly marketable stuff. There's a little bit of these Series E bonds and that kind of stuff in there, but that it's so tiny it's not worth talking about. The blue line is what they call the total public debt, but that includes these what do they call them now? I'm having a senior moment. Things for Treasury, for the Federal Reserve Security Fund. This is trust fund. Mm-hmm. So these are the ones: trust fund for Social Security. There's one for a whole bunch of different things. And so the difference between these numbers is this fictitious trust fund. Basically, if they write a check for the money they spent, or write a promise to issue debt for the money they spent in excess of the money they had, right? So they're going to guarantee you they're going to spend that money. Of course, that guarantee is like all guarantees, government guarantees, not worth the paper it's written on. All right. So basically, take Social Security, for example. I think they crossed the threshold before 2010. Social Security revenue was exceeding Social Security payments. All right. So basically, that additional revenue was being used, right, to finance other spending, and they were writing a promise, right? They were adding to their promises of that they were going to issue debt to finance that spending at a later date. All right. So we crossed that line. So right now we're in a situation where Social Security expenditures are exceeding Social Security revenue. So now we're drawing down the Social Security Trust Fund. And I don't know, the CBO, Congressional Budget Office, always makes an estimate of where that's going to round out. And I think it's somewhere in 2035 or something like that.
It gets closer and closer every time they do the estimate.
But the truth is, what are they going to do when push gets run to shove, when it gets hard? They're going to raise the age limit. They're going to means test it. They're going to do something.
Yeah. I've always heard that eventually they'll raise the employer and the employee's tax 1%. Yeah.
More than likely, that would be one of the first things they'll do. So they're going to change the program, period. All right. So anyhow, that's the difference. So when you talk about the national debt, you should always be talking about the red guy and ignoring the blue guy. Yeah. All right. So when did this start? Well, the deficits really started growing back here in we had a few surpluses back here. So this is obviously World War II. And then we had a few surpluses. And then basically around 1960, it started to getting bigger in the mid 60s. And then it's basically been going. There were 4 years under the Clinton administration where we had a surplus. That's it. So basically, we've been running these bigger and bigger deficits almost consistently since the 70s. They're just getting bigger. This has a percent of GDP, but it doesn't make any difference how you slice it. It'll be the same. So if the next one after that says, well, is that due to spending or taxing, not getting enough tax? Well, again, the red line is expenditures and the blue line is revenue. And so it's basically expenditures exceeding revenue. Although here lately, I mean, beginning in 2000, the revenue has been declining, but expenditures going up. And then with the COVID thing, they're going way up.
Way up.
Because this ends in 2020. These are annual data, so it ends 2020. The 2021 was not available at the time, but it might be now. So it's basically increasing expenditures, and most of this expenditure increase is due to these so-called, like Social Security and that, things that are just have to be paid, basically.
Right.
So basically, that is that situation. I'd like to back up, if we could, and talk a little bit about a little bit more about the effectiveness. Yeah. I'd like to hit that, and then we can end talking about the debt a little bit. I don't know how much more time you want to devote to this or not.
Yeah, we were getting close, and so that's where I wanted to end on the debt, because that marriage of the fiscal and monetary policy, right, the Treasury and the Fed, I think hits on that a little bit. But go ahead.
Yeah, but this is just my list of things that happened as a result of the latest QE policy. And this gets us, basically nothing happened. This had no effect on output, and it wasn't going to affect output because there's nothing in economic theory that says monetary policy can do anything about the path of output associated with the pandemic. So that path of output is going to be completely determined by the pandemic, vaccines, people's willingness to take the vaccines, blah, 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 blah. Monetary policy isn't going to do anything. But now we've ended up with a situation where we have what? The Fed is now holding 26.5% of marketable Treasury debt. They're holding 26.5% of that red line, right? And they currently hold an outstanding 20% of outstanding MBS, all right? So this gets to the question of the debt and what we can do about it, and whether or not it's going to be a problem for us. There's something called modern monetary theory, this idea. I don't know if you've heard about it. You know what it is?
Stephanie Kelton's book.
Yeah, so I do Audible, so I just downloaded that book. When I finished the current one, which is Sapiens, A Brief History of Mankind, which is really good. Okay. I'll start on her book. But anyhow, they have two basic fundamental premises. The first one is you're never going to pay back the debt. Debt's never going to be paid off. That's absolutely true. Right? Anybody thinks we're going to pay off this debt, yeah, they're not walking on the planet. There's someplace else. The second one is that you can't default on a debt that's based in your own currency. Right? That's absolutely incorrect. Right? You can't. So if we skip down to those debt slides, so the key here is debt service. All right. So it's the next slide, I think you want to put up. That one. So debt service is basically determined by how much debt you have and what interest rate you're paying on that debt. All right. So basically, this is the 10-year Treasury rate, and it peaked out here in the 70s, early 80s sometime. This is actually early 80s right here. And basically, this rise here in the federal outlays and debt service was largely driven by the fact that interest rates were so high. So as interest rates started coming down, this thing kind of began to fall off, because even though we were increasing the debt, rates were falling at a faster rate until it came down. But now interest rates, debt service has been going up dramatically, which is over here on the left-hand side, the amount of debt service in billions. And interest rates have been going down. So now what's pushing debt service, keeping debt service from being astronomically high, is these low interest rates, right? So basically, if you go to the next one, this has interest payments in billions. So this is just up here now. This is this one here, I think, is 2020, 21. So in 21, we were paying a little about, I'd say about 560 billion in debt service, right? And this here is the blue line is the interest, average interest on the debt, all right? So what happens is, if you go to the next slide now, all right, so this is interest as a percent of GDP. This is interest expense. So the peak here was about in the early 90s of about a little over probably about 3.2% of GDP. All right. The debt continued to go up, but our debt service went down again because what? Interest rates had been falling.
Mm-hmm.
Right. So basically, the question is, you could get into a situation if interest rates start rising. So, for example, this inflation really gets going, then interest rates are in fact going to go up a lot, right? And you can get in a situation where the percent of debt service, right, as a percent of GDP gets up maybe 5-6%. All right. Right now it's pretty low. It's at 1.5% of GDP. But you get that debt service up there at 5 or 6%. You could get in a situation where people start getting a little skittish about whether or not you're going to be able to pay it.
Mm-hmm.
Right. And if that happens, you can, in fact, get a debt problem. So if you go to the next slide, so this is the percent, this is the amount of the debt held by the Federal Reserve, which we said right now is about 26.5%. This is the amount held by foreigners, which is about 35%. So foreigners might start becoming a little more nervous if your debt service gets high relative to your GDP. And remember, the trend in GDP up to now, since the 1940s, has been declining. No one's, I don't know what's going to continue to decline, level off, but if it continues to decline, right, then that debt service as a percent of GDP is going to accelerate,
Mm-hmm.
right? And basically, what happens if the Fed has to sell off this 26% and get it to probably what is driven by money growth of amount, would probably have to sell it off to the point where we would own maybe 10% at most. So they have to sell off about 15%. So that means that 15% of debt has to be financed someplace in the public, either by foreigners or US citizens. So you could get a situation going where people become concerned about your ability to service the debt. And especially when we have all these things, the confluence of all kinds of other debt problems. For example, almost every state, right, has unfunded liabilities, mostly retirement benefits, in huge amounts. Some states like Illinois, for example, are just terrible. Their future liabilities are so underfunded, it's not even funny. So you have all these other things. Besides that, we have all these payments here that we've guaranteed, right? And so can you generate enough revenue, increase taxes enough to make all those payments, right? And once people start wondering whether or not you're going to do those things that are necessary to enable you to finance your debt, you can have a debt default. Now, debt default doesn't mean you pay off it doesn't mean that you don't make payments. It means that you have to renegotiate your payments. Mm-hmm. This is exactly what happened to Greece. They renegotiated, they made payments, but they had Germany and to a lesser extent, much lesser extent, the Netherlands come in and bail them out, right? Nobody can bail out the United States. In fact, if it happens, if Spain or Italy had a debt default, nobody can come to their rescue. Nobody will come to their rescue. All right, so you can have, and there have been a lot of debt defaults, mostly in Latin American countries and other, but any country could have a debt default if they don't watch their P's and Q's. And I
So,
don't see us watching our P's and Q's particularly well.
and
It
that
could happen.
and that may be kind of my final question as we come to some conclusion here. As you lay that out, and as I think about it, even though QE, as you laid it out, was an experiment gone wrong. Again, I don't want to put words in your mouth, but I think that's at least my impression of it after hearing it from you. How do they step away? It seems like they have to continue to play in the pool to allow the funding of the government without. Does that make sense? Am I thinking about that?
No, I think that's right, but it wasn't a policy that went wrong. It was a policy that should have never been adopted. You know, in that meeting in March of 2009, there were at least 5 Federal Reserve Bank presidents that raised concerns about the credit allocation aspect of that program, which is a complete break with Fed history. So this is like a complete change in what the Fed had done historically. And also, Charlie Plosser, who was the president of the Philadelphia Fed at the time, made the observation that, you know, credit allocation is really the job of the Treasury and Congress. It's not something the Fed should even be involved in. All right, so it's not monetary policy. We're doing fiscal policy, right? Not monetary policy. So basically, it's something that should have never happened. You should have stuck with your tradition of having no influence or minimal influence on the allocation of credit, interest rates, and the allocation of credit. We didn't do that. So now we're stuck with this thing. And I think we've crossed the line between monetary and fiscal policy to such an extent that we're at the point of no return. This means anybody who believes there's an independent Fed may want to think real hard about that. I don't believe the Fed is independent at all anymore. And in fact, this whole thing could accelerate. You know, if you can buy MBS to help the housing market, well, why don't you buy college debt? You know, why don't you buy auto backed securities or college debt backed securities? Why don't you help those markets too? Right? Those markets need help. Right? Once you've crossed that line, you've kind of reached the point of no return.
And then you get into the situation of, until your hand gets slapped, you almost have this false sense of security.
Yeah.
Right?
Yeah, I didn't think anything. I always said the Federal Reserve would probably be changed if anybody had a better idea. Right? And I said this early in my career. Right? But nobody has a better idea. So nobody likes the Fed, but the Fed is there, and you know, it comes under attack. But now I'm to the point thinking that we might be in a point where we actually see we've already seen a fundamental change in the Fed. It's now heavily involved in allocating credit. In fact, at one point we were buying municipal, state, and municipal bond, right, for a short period of time. That was associated with the CARES Act.
We picked up exchange traded funds.
Oh yeah.
Yeah.
No, I mean, so, you know, you can, once you cross this line, there's all kinds of stuff you can do. And I don't think any of it is things that we should have done. And none of this is stuff that we historically have stayed away from.
Wow. A very interesting conversation. And if I may say, a call for those economists that are out there that are searching and researching to think of new and innovative ways to tackle monetary policy.
Yeah, I'm doing that myself.
So Dan, I want to give you the last word and plug. And if I could even ask you, you mentioned when you and I first started that you were considering and in the process of writing a book. So I want to give you a chance to plug anything and everything for people to find your research and find a way to get a hold of you?
Well, you can find my research at dlthornton.com. So it's very simple. There's an essay tab there that you can click, and you can see all the essays I've written since I've retired. I'm writing a book. The working title right now is the Macroeconomic and Monetary Policy and Theory Myths, which is basically all of macro, in my opinion. So the book really works hard to take every idea and show that there is no real world counterpart to it. Right? If there's not a real world counterpart to it, then it's a myth. Right? And then at the end, I'm going to offer my suggestion about how both monetary and fiscal policy can and should be changed based on economic reality, based on things that economics has a lot to say about, right? And things that aren't, mythical. They're basic ideas that are well-founded and actually challenged and held up empirically very well. So that's the whole point I'm doing. I have no idea when this project is likely to be done. So
That's the beauty
working on
of
it hard, and we'll see.
that is truly the beauty of good research, though. It takes time. So Dan, I do greatly appreciate your time and you laying this out for our audience and our viewers today. For those of you that are listening, please take the time, go find some good articles and good essay. Dan writes all the time and posts very often online and on LinkedIn. That's where I primarily found you and saw you, Dan. So with that, we hope you all had a great conversation here, and we'll bring another video back to you all again in another week or two.
All right. Thank you very much. Appreciate it.
Thank you, Dan.
All right. Bye-bye.